For decades, graduation meant freedom. But for millions of students today, graduation is the moment anxiety actually begins. What if education didn't unlock opportunity, but quietly locked people into pressure?
So as it turns out, the student loans that I've been paying $1,500 a month for 2 years have a 17% interest rate.
I am over $100,000 in debt because of student loans.
There was a girl on here, they had $600K in student loans.
Over 42 million Americans carry student loans, $1.8 trillion in total debt, second only to mortgages. And this isn't abstract. Roughly 1 in 10 federal borrowers are in default, meaning they're 270 plus days past due. But here's what the numbers don't show.
Nearly 1 in 3 borrowers haven't made a single payment in at least 90 days. Now, that's the highest delinquency rate on record. And according to TransUnion, it could get even worse.
About 5 million people are currently in default, and federal officials estimate that number could swell to nearly 10 million soon. Pew Research confirms that many borrowers don't feel financially secure, with about 51% saying they lack financial stability while making payments. This crisis isn't a statistic, it's life pressure, and it's accelerating. Most discussions focus on politics or forgiveness, but Stanford researchers asked a deeper question. What if the problem isn't just how much students owe, but how repayment works? Because right now, about 25% of borrowers are expected to default within 5 years of entering repayment. That's not individual failure, but system design collapsed. Student loans were marketed as an investment. Borrow now, earn more later. Success was assumed. But education doesn't guarantee income. Some graduates make a lot, some don't. Yet the system treats everyone the same. Stanford's professor Tim De Silva explains it this way. College is a large but risky investment that may or may not pay off. Early-stage businesses finance risky projects using equity, which provides insurance. If the venture succeeds, investors profit. If it fails, losses are shared. But student loans work the opposite way. All risk falls on the borrower, none on the lender. That mismatch is where damage begins. Student loans behave differently than credit card or medical debt. Unlike most debt types, student loans are extremely hard to discharge in bankruptcy. Fewer than 0.5% of borrowers ever succeed. You can walk away from a car loan, negotiate medical debt, but student loans follow you for life. So when life gets hard, unemployment, illness, instability, the debt doesn't soften, it stays. And when borrowers fall behind, the federal government has extraordinary collection powers. Pew Research shows the process of repayment itself creates stress. Borrowers face confusing paperwork, rigid rules, and administrative delays just trying to stay afloat. And even borrowers who are in good standing, making every payment on time, report profound anxiety. In Pew's survey, 52% of new borrowers said it was difficult to afford their monthly payments. 36% said their student loans were more stressful than other bills. And 56% reported that their income varied month to month, making it impossible to predict whether they could pay next month's bill. For many, especially those with low or unstable income, the consequences of falling behind are devastating. Wage garnishment starting at 15% of after-tax pay, seized tax refunds or Social Security benefits, damaged credit scores for up to 7 years, and loss of future federal aid eligibility. And here's the cruelest part. Over 2/3 of borrowers who default once will default again. Because the system doesn't just punish failure, it traps people in cycles they can't escape. This isn't frustration, it's financial trauma. That doesn't just affect money, it shapes lives. Britannica reports student debt reduces the likelihood of home ownership and shrinks retirement savings, delaying major milestones like marriage and financial independence. More than half say payments are difficult to afford, and many carry volatile income and expenses that make repayments unstable. 3/4 of borrowers, 75%, experienced at least one negative financial event in the past year, couldn't pay rent or mortgage on time, overdrew their checking account, and had to apply for public assistance programs. This isn't a choice, it's pressure. Pressure that compounds every month, pressure that derails entire futures. Stanford GSB research proposes a bold rethink. What if student loans worked like insurance, not punishment? Instead of fixed monthly bills, consider income contingent repayment, payments that scale with earnings. Earn more, pay more. Earn less, pay less. That way, debt feels like shared risk, not a guaranteed penalty. Professor Tim De Silva's research shows this approach can reduce financial strain while protecting consumption over a lifetime. His data also shows that moving from fixed payments to income-based repayment increases household average lifetime consumption of goods and services by nearly 1.5%. And here's the remarkable part. This isn't about forgiveness or taxpayer burden. The system just spreads payments across times when people can actually afford them. This isn't theoretical. Australia has used income-linked repayment for decades. They were the innovators, introducing income-contingent loans back in the late 1980s. De Silva analyzed data for the entire population of over 4 million Australian student loan borrowers. The findings, while some borrowers reduce work slightly to lower payments, the net economic benefit is significant, reducing financial pressure without destroying incentives. This model prevents collapse during low-income years, when pressure does the most damage. And critically, restructuring existing loans from fixed repayment to a well-designed income contingent system increases borrowers' welfare at no additional fiscal cost. The insurance value outweighs the costs. In the US, income-driven plans already exist. Save, Pay, IBR, ICR. 4 programs, hundreds of pages of rules, and most borrowers who qualify never enroll. Pew finds many borrowers struggle to enroll or stay enrolled due to administrative barriers and confusing processes. This means a tool that could help people often goes unused. And it's not because borrowers aren't trying. Pew's research revealed real-world barriers, burdensome paperwork requirements, administrative delays that leave people without affordable payment options, and systems built on outdated technology that can't adapt quickly to policy changes. That's a design failure, not a personal one. Britannica outlines the major policy proposals, forgiving $10,000 or $50,000 per borrower, or even canceling all debt. But forgiveness alone doesn't fix rising tuition costs, confusing repayment systems, barriers to affordable repayment. Stanford's research agrees. Forgiveness treats a symptom, not the architecture of the system. And Pew points out that many who default once, over 2/3, will default again, trapping people in cycles without clear paths to stability. Student debt doesn't just burden individuals, it slows the economy. Britannica notes economists estimate that reducing or resolving student debt could unlock tens of billions in GDP annually, not through handouts, but by freeing people to build, invest, and create. When talent is trapped in survival mode, entrepreneurship, mobility, and innovation suffer. This crisis isn't isolated. It's a slow drag on growth, on potential, on an entire generation's ability to contribute fully to the economy. Student loans aren't pushing students to the edge because they failed. They're pushing them to the edge because a system built on assumptions hasn't adapted to reality. Until repayment is redesigned for the world we live in, this crisis won't fade. It will compound. But redesign is possible. The research exists. The models work. What's missing isn't knowledge, it's will.